Every country on the planet carries debt. The United States now owes more than 38 trillion. That is the largest figure it has ever recorded. The European Union carries something on the order of $14 trillion. Japan sits near $9 trillion. Even nations that look cash-rich from afar, petrostates with oil in the ground, or export titans with trade surpluses, also carry towering liabilities. Germany owes, China owes. The list runs to every flag you can name. And yet, this creates a puzzle that sounds almost like a trick. If everyone owes, who is the creditor on the other side? Who holds the claim when every sovereign balance sheet shows obligations? This is the domain of the financial historian, the junction where money, power, and historical habit intersect, and where simple answers rarely survive contact with the facts. Debt is not merely a weight to be dragged behind a nation. It is the scaffolding of the modern order. Every war fought, every crisis endured, every boom and bust you can chart sits atop a lattice of contracts promises to pay that knit households, firms, and governments together. And if you trace those IOUs far enough around the world, the trail ends in an uncomfortable place. The planet largely owes money to itself. That doesn't mean the gains and burdens are shared evenly. It means the loop closes within the same global system. To see how we arrived at a world whose total debt load exceeds $315 trillion, nearly 3 times the size of annual global output, we have to wind back long before credit cards, online banking, or instant transfers. The original idea of national debt was not a Wall Street invention. It was a wartime solution. In 1694, England was in a protracted fight against France and running short of gold to finance it. The monarchy confronted a hard limit. The treasury was emptying faster than coin could be raised through taxes or captured through conquest. The crown turned to the merchants of London and offered a bargain. In exchange for a perpetual stream of interest funded by future taxation, they would lend to the state. To manage that new arrangement, the Bank of England was founded. The innovation was profound. The government could now spend money it did not yet have in hand. In turn, lenders received something of immense value, an enforceable promise from the state that could be traded, priced, and treated as property. That was the birth of the modern government bond, and, with it, the seed of the system we inhabit. Other powers imitated the model. France adapted it. The Dutch perfected techniques for trading and pricing those promises. The newly independent United States relied on it to finance the revolution and later to knit together expansion across a continent. Debt ceased to be a badge of failure and became a marker of credibility. The ability to borrow at reasonable cost was the ability to project power. Empires no longer needed to seize bullion to fund themselves. They could issue bonds and extract interest instead of metal. What had been decided on battlefields increasingly shifted to balance sheets. Jump forward 3 centuries, and the old mechanism has scaled to the size of a world. Debt is now the most pervasive export on Earth, an instrument every sovereign issues and every large institution holds. The United States owes roughly $38 trillion. Japan owes more than $9 trillion. Worldwide borrowing grows by the equivalent of around $1 trillion every 100 days. Each country is a debtor. Each bank, fund, and household is a creditor in some capacity. Through taxes we pay, deposits we hold, contributions to pensions and insurance we make, we are all participants on both sides of the ledger. But if we want to see who grips the other end of the rope most directly, start with the largest single issuer, the United States. American debt is not only national, it is global in use and reach. Of that $38 trillion, about half is held outside of government accounts, owed to investors rather than to other arms of the state. Roughly 2/3 of those investors are domestic. American banks and broker-dealers, pension funds, mutual funds, insurance companies, and the Federal Reserve itself as the central bank. The remaining third, on the order of $9 trillion, sits in foreign portfolios. Japan is the single largest foreign holder, with around $1 trillion of treasuries. China holds roughly $800 billion. After them come the United Kingdom, Luxembourg, Belgium, and other financial centers or reserve managers. So, the phrase America owes China contains a truth, but it is a narrow slice of the total, on the order of a couple of percentage points. The overwhelming share of what the United States owes is owed to Americans. The mechanics look circular because they are circular. The Treasury auctions bonds. Domestic banks, funds, and households buy them. The Federal Reserve at times purchases those same securities in the secondary market, paying with newly created dollars and expanding its balance sheet. Americans then pay taxes, and part of those taxes funds interest on the outstanding debt. Those interest payments stream back into American retirement accounts, insurance reserves, and bank assets. The liability of one entity becomes the income of another within the same system. The debt is real, but the creditor, in aggregate, is often a mirror. And this hall of mirrors structure is not uniquely American. It is planetary. Japan channels savings into U.S. Treasuries. The United States channels dollars into multilateral lenders that support European programs. Europe lends onward to developing economies through institutions like the World Bank. Those same developing countries recycle excess foreign exchange back into Western bonds as reserves. Every pair of hands along the chain holds someone else's IOU. Every promise is secured by the value of another promise. Picture a card table where each player is staking chips borrowed from the next seat over. The game can continue indefinitely so long as no one stands up and refuses the arrangement. The continuity of the system relies on the decision to stay seated. Behind this choreography is a fourth layer that exerts the most quiet power, the markets themselves, meaning the network of large institutions that set prices, enforce discipline, and calibrate risk. Hedge funds that trade sovereign spreads, pension funds that allocate to core fixed income, sovereign wealth funds that warehouse reserves for generations, and above all, central banks that steer liquidity. All of them sit behind the public balance sheets moving tens of trillions. They are the arbiters of credit in practice. They determine which issuers enjoy cheap financing and which must pay up to survive. When the tide of confidence goes out on a nation, the result is swift. Currencies can collapse. Governments can fall. Entire economies can be reorganized in a matter of months because the cost of rolling debt jumps beyond what a budget can sustain. Ballots determine who governs. Markets determine the price of survival. At the apex of that architecture sit the central banks, the modern high priests of this order, because they do not merely manage debt, they manufacture it. Each time a central bank such as the Federal Reserve or the European Central Bank buys government bonds, it conjures reserves into existence and exchanges them for the debt. An entry on one balance sheet becomes a funding source on another. The money in circulation is the asset form of somebody else's liability. There is no category called debt-free money inside the current system. Coins, notes, and digital dollars trace back through layers of intermediation to an IOU. The loop persists on confidence. As long as investors believe a government will service the interest, whether or not it ever retires the principal, the machine continues to turn, but confidence can hesitate. And when it does, the abstract becomes immediate. We have already seen the mechanism fail in real time. In Greece in 2010, the sovereign's obligations became too large to fund on market terms. Bond buyers fled. Yields spiked to punitive levels. The response from lenders of last resort, the European Central Bank and the International Monetary Fund, stabilized the numbers, but with strict conditions. Taxes rose, spending fell. Unemployment surged. For a generation of citizens, the term bailout meant sacrifice imposed from outside. In Argentina, repeated defaults etched debt into political memory as a recurring crisis. In Sri Lanka, the inability to secure enough foreign currency to honor obligations translated into fuel lines, shortages, and a government in turmoil. When the system breaks, the anonymous creditors gain shape. A multilateral institution sends a mission. Ratings agencies reprice a country's risk. Bondholders insist on new terms. Then, after the worst, the loop resumes. Old bonds are swapped for new ones. Maturities are pushed out. The rollover machine spins again, with the same names holding modified promises. The logic restarts because the structure is designed for continuation, not for closure. That is the central point. In the 21st century, sovereign debt is not meant to be extinguished. It is meant to be refinanced. Governments do not propose to pay everything back at some future date. They propose to maintain the stream, retire yesterday's bond with the proceeds of tomorrow's issue, keep interest current, and preserve the instrument's status as a safe store of value. Economists simply call this refinancing. The interest becomes the true product, a rent paid for stability. The global economy has adapted to live on that rent, like an organism that must keep moving to breathe. On those terms, the United States will not pay off $38 trillion. It will service and refinance it for as long as the system lasts. Japan has done the same for decades, with a public debt load far above its annual output and yields that remain near the floor because buyers expect the contract to be rolled, not redeemed. Investors in that world are not awaiting a final repayment. They are awaiting a renewal. Why would they accept that arrangement? Because for the institutions that anchor the system, government debt, especially the obligations of large, stable issuers, functions as the best collateral money can buy. A U.S. Treasury is treated less like a burden and more like a building block, a base layer for portfolios, a liquidity backstop for banks, a core holding for central banks. The system depends on those instruments existing in size. A thought experiment shows why. If Washington somehow decided to retire the entire stock of debt, the world's most stable asset would vanish from balance sheets. The supply of safe collateral would contract. The pool of dollars linked to those bonds would shrink. The knock-on effects, deflationary pressure, broken funding markets, disorder in banking, would be immediate. In other words, paying everything down would destroy the tool that makes the machine run. So governments do the reverse. They issue in a cadence, not randomly, and aim to keep the debt desirable. The pulse of issuance is a kind of heartbeat for the system, transmitting through pensions, mortgages, and markets everywhere. This is why appeals to balance the budget or to pay down the national debt are political slogans, not operating manuals. The goal is not elimination. The goal is sustainability. A debt stock that investors want to hold, a service cost that taxpayers can bear, a maturity profile that can roll in bad times as well as good. Because once credibility erodes, arithmetic loses its cushion, rates gap higher, rollover windows close, and the economy built on rolling promises grinds down. That is the secret of sovereign debt in plain language. The plan was never repayment in full. The plan is to keep the belief in repayment alive. It is a closed loop of trust, and as long as that trust persists, numbers can stretch farther than intuition would allow. In practice, sustainable means three things working together. First, a primary budget path that keeps debt from accelerating faster than the base of the economy. Second, an investor base broad and patient enough to absorb new issuance at tolerable yields. Third, a maturity ladder that avoids bunching, so large chunks do not come due all at once when conditions are strained. Credibility is the hinge. If investors believe the issuer will keep servicing, the term premium stays contained. If they doubt, required returns jump, and interest itself becomes the channel of stress. Policy, then, is less about zeroing the stock and more about managing its duration, currency, and cost, so the compounding never outruns capacity. That is why steady signals, transparent funding plans, and predictable auctions matter. They anchor expectations and keep the loop intact even when growth cools or shocks arrive. But the claim that we owe it to ourselves only captures half the reality. Trust is not equal in distribution, and neither are the flows of income created by the system. Interest payments do not disperse evenly through society. They flow upward and inward, from taxpayers and wage earners toward the institutions that collect coupons and clip spreads, pensions, insurers, funds, banks, and the savers they represent. Debt is not only a transfer among nations, it is also a transfer among classes. That is why measures of inequality and measures of indebtedness often rise together. The same machine that stabilizes the whole tends to reward those with the capacity to hold claims and to penalize those whose role is to fund the claims through taxes and consumption. This pattern does not require villains or victims. It requires an engine that treats creditors and debtors as functional opposites within a single design. Who benefits most are balance sheets that can warehouse safe assets and harvest yield. Who pays most are those whose cash flows are taxed to cover service costs, or whose wages adjust slowly when prices and rates shift. The distribution also runs through time. Current holders receive income now, while future taxpayers inherit service obligations embedded in today's choices. Even within the same household, roles split pension savings may gain from coupons, while take-home pay bears levies that fund them. The phrase "to ourselves" obscures these asymmetries. The system nets to zero in aggregate, but the path of payments determines who accumulates claims and who supplies the cash. Understanding debt, therefore, means tracing not just stocks, but flows, who receives interest, who remits it, and how policy tilts that channel. The design runs smoothly until the underlying fuel confidence and growth falls short of the promises already made. When fresh borrowing can no longer keep pace with obligations contracted years or decades earlier, the abstract question, who is the creditor, stops being philosophical and becomes personal. People go looking for faces. They point to one country or one set of bankers or one institution. But at the top of the pyramid, there is no single villain to name. It is not just a foreign treasury. It is not just a financial district. It is not just a multilateral agency. It is all of them. And it is us. Because the modern system has blurred the line between money and debt until they look the same. Governments issue the liabilities. Banks multiply them through lending. Investors trade them the way previous generations traded coin. Citizens save in them and depend on them for retirement and security. The distinction between who owes and who owns has been eroded by the very instruments that keep the structure standing. When confidence thins, the mechanics show through. Funding costs climb, maturities shorten, collateral haircuts widen, and markets begin to demand cash instead of promises. That shift tightens financial conditions, slows activity, and makes the next refinancing harder than the last. Feedback takes hold. Credit risk begets higher yields. Higher yields raise service burdens. Heavier burdens strain budgets, and strained budgets unsettle lenders further. The same loop that stabilizes expansion amplifies stress on the way down. The question, who holds the claim, resolves into a network answer. Many do, across institutions and households, and the network only functions while belief in convertibility and service endures. Once upon a time, to be in debt carried a clear image: bondage, loss of freedom, a chain attached to a creditor. In the present order, the same word means balance. It describes a set of offsetting entries that, if maintained, allow an economy to function at scale. But that balance is not guaranteed. If it tips, if trust fades, then the varnish peels away, and we remember what a debt is at its core, a promise that cannot be deferred forever. The safeguard is not an accounting trick. It is the steady pairing of obligations with credible cash flows and the steady renewal of claims at prices the issuer can bear. When that pairing falters, adjustment arrives through a narrow set of paths: fiscal choices that reprioritize spending and revenue, monetary choices that influence the price of funding, and restructuring choices that change terms when the old promise is no longer clear. Each path redistributes burdens between present and future, between payers and holders, and between domestic and external balance sheets. The modern system can absorb shocks because its promises are widely held, and deep markets exist to trade them. Yet, precisely because promises are everywhere, lost confidence moves quickly. The practical lesson is simple. Sustainability rests on predictability, transparency, and discipline strong enough to convince buyers that tomorrow's rollover will look like today's. When those conditions hold, debt functions as operating infrastructure. When they do not, the infrastructure reveals its nature as a contingent claim on future effort. History preserves that truth beneath the surface of normal times. When the surface cracks, the definition becomes visible again.